So this is the part of the show where I talk about what I believe is important for individual investors to think about before you make your investment decisions. And I always pull out three topics for everyone to consider. Sometimes they're macro, sometimes they're more company specific or micro. Today we have a bit of both. We're going to talk about Fed strategy, what the Fed is going to say a couple hours from now, and what they're going to, say about the future. Will they continue to raise rates as aggressively as they have been, or has this bank crisis taken a lot of steam out of how they feel about the economy? We also are going to talk about U.S. inflation. U.S. inflation is definitely something you need to keep an eye on before you make your investment decisions. If we see U.S. inflation start to tick higher once again, that obviously will be a bad thing for the stock market, and that could cause the Federal Reserve to raise rates even further. Here in our country, we've been on pause for quite a while, for the last couple of meetings anyways, with respect to rising interest rates. But again, if we see inflation numbers in our country rise, that would mean that the Bank of Canada could be forced to start raising interest rates here again. So keep an eye on that. The second topic we're going to touch on are bond yields. I think everybody should keep an eye on what the bond yields are doing. In the US, we've seen bond yields crash down over the last few weeks. The two-year bond yield well over 5%, now just above 4%. It actually got below 4%. So bond yields, interest rates, these are things that need to be watched before you make your investment decisions. And lastly, stock valuations. Which stocks make most sense at this point in time to move your money into? You got to take a look at the charts. You got to understand what's going on internally at these businesses. And you have to understand what's going on with respect to the macro. And is the macro causing stock valuations to be lowered, even though the underlying business itself is doing quite well? In which case, I would say that could be a buy opportunity. So stock valuations is something to consider as well. So let's touch on the first topic, Fed strategy and U.S. inflation. So you can see here, we have a chart we'll pull up in a second. U.S. inflation numbers have now dropped to 6% in the United States. Core inflation is still staying stubbornly high, 5.5%. What core is the number that you get once you X out volatile food and energy. Now, I really don't like to X out food and energy because those are the two main things that affect us every day, price of food and the price of energy. So I always look at the core number. And to me, you're seeing actually the core, when you see 5.5, why that is only slightly below the overall number. To me, that just means that a lot of the inflation that we've seen come out of the system, out of the economy in the US, and even here in our country, is because oil prices have fallen so much. So when you don't factor in falling oil prices and you look at other parts of the economy, you can see that inflation is staying stubbornly high. And that, in my opinion, is why the Federal Reserve continues to want to raise interest rates going forward. So at 2 o'clock this afternoon, the Fed will tell us what they're going to do. They're going to either raise a quarter point. They could basically pause and say, based on what's going on in the world today, we're going to take a more of a wait and see approach. I don't think they're going to raise 50 basis points, even though about 2 weeks ago, the talk was that they may raise 50 basis points, but I think that's off the table now. So overall, you want to take a look at what's going to happen at the meeting this afternoon. You want to understand what they're saying. The stock market's going to parse through every word the Fed says, every pause, every intonation. It's kind of silly at some point, but I think the Fed is going to raise 25 basis points, and hopefully they'll take on more of a dovish tone, a tone that says 25 and perhaps maybe indicate that they may pause for the time being until they see this banking situation play itself through. So that's what I think they're going to do at 2 o'clock. But again, once Jerome Powell has his speech, all the Fed officials will probably speak in the coming days, and each of them will have their own opinions. And that, unfortunately, will move this market. And for individual investors, yes, it's kind of a whipsaw effect, but you need to watch what the Fed governors are saying, what the inflationary data is telling us. It's definitely coming down in the US, but nowhere near their 2 to 3% mandate. Second topic that I think individual investors need to focus on, as I mentioned, are bond yields. And you could see here The bond yields that we have up, there is the 2-year bond yield, which we'll show you. And you can see how much the bond yield has fallen. And that is based on the banking situation in the US, the banking crisis, if you will. The 2-year prior to the banking crisis was over 5%. If we scroll down a little further, or we can show the 10-year bond rate, that now is under 4% at 3.6. That actually got as low as 3.5%, 3.4% recently, and it started to tick a little bit higher now that federal government in the US has come in to save the day and guarantee these deposits at these banks. So now we're starting to see bond yields move higher. I think the 2-year got down to actually under 4%. So what does this mean for individual investors? Well, once upon a time, higher yields meant not good thing for the stock market. The higher the yield, the more competition for the stock market. Why would somebody want to buy a dividend-paying stock paying 4% when they can make 5% on a low-risk 2-year government bond? Today, I think it's a little different. Today, I think higher interest rates means a healthier economy. And maybe the stock market actually wants to see higher rates, maybe not too high, but higher than where they dropped to recently. Because when we see interest rates drop as quickly as they did, as low as they did, that usually means there's something going on, something wrong in the economy. So once again, we don't want to see too hot. We don't want to see too cold. We want to see bond yields just right. So if bond yields tick up a little bit from their recent lows, I think that's a healthy sign. I think that's a sign that will tell individual investors that this banking crisis, or at least the worst of the banking crisis in the US, could be over. The worst of the banking crisis in Switzerland, with Credit Suisse being taken over by UBS, the 2 largest financial institutions in that country, could be over. So I think higher yields on the 2-year and 10-year in the US could be actually a positive sign. We just don't want to see them get too high. So keep an eye on bond yields. Last but not least, the third topic that I think individual investors need to focus on before you make your investment decisions is an obvious one, and it's one we talk about all the time: stock valuations. Where are the cheap stocks today? Well, if you're saying bank stocks, you're 100% correct. Bank stocks have sold off quite a bit. And I know individual investors are asking me, why are our banks selling off? We have nothing to do with what's going on in the US. Why is Bank of America, JP Morgan, 2 of the largest banks in the US, selling off if this is a problem with smaller regional or community banks? The answer is very simple. When you look at ETFs or bank ETFs, ETFs are a basket of many different banks. In baskets, you will have Canadian banks, US banks, different banks around the world, European banks, Asian banks. And so what happens is when there's a banking crisis in the US, the largest economy in the world, investors tend to sell off not only individual stocks, but also these ETFs. So if you're a bank here in Canada, Scotiabank, and you have nothing to do with what's going on in the US, but you're a part of this ETF, you're going to see your stock price sell off as well, because the ETF or basket of banks has sold off in sympathy with what's going on in the US. However, in my opinion, that gives us great buying opportunities. So let's take a look at a few charts here. We have one of Bank of America. You can see how Bank of America chart, there it is, has sold off substantially. It's down probably close to 40%, in and around 40% from its highs that we saw just over a year ago. We have another chart here of Wells Fargo, another very large US bank. They're under $40 now. They once were as high as $60, as you can see in the far left of this chart. So here are 2 large US banks that I think represent fantastic value, opportunities for individual investors to get into these banks, get a little bit of a dividend. Both Wells Fargo and Bank of America pay just over 3% dividend, but an opportunity for growth. When everything settles down in the coming days and weeks, then I think these banks will gain a lot of their value back. A couple of Canadian bank stocks to highlight. One is one of our largest bank stocks, TD Bank. TD Bank, second largest, arguably the second largest in our country. You can see how much that bank stock has fallen off. Once $109 a share, now under $80 a share. Wow. This bank is now paying close to a 6% dividend. I think a great opportunity for conservative investors, not only to make a great yield or good income from the dividend, but also great opportunity for growth going forward. And I think our last chart here from a bank is Bank of Nova Scotia. I've been bullish on Bank of Nova Scotia for quite some time. They're down as low as $66, $67 a share, down from the mid-90s not too long ago, just over a year ago. Again, their yield is over 6% and a great opportunity for growth. So looking at stock valuations, right now, there is no doubt that valuations or great bargains are in the banking sector. You could look at large US banks, you could look at large Canadian banks, you can even look at some of the larger regional banks like PNC Financial. PNC Financial, one of the banks that actually lent money to First Republic Bank to help them out in this difficult time. So obviously they have a lot of cash on hand, yet their stock has been cut by more than half, more than 50%. So a name like PNC Financial represents tremendous value in my opinion. Again, as long as you're an investor that can handle the volatility of owning a bank stock, there are a lot of great bargains, great stock valuations in the banking sector.